Well, so today we're going to talk about zero trade costs, and that's obviously something that's hit the news here in the last few weeks, more so than before, and I think it's interesting primarily because of course Robinhood came out with zero trade costs kind of as their get go, and everybody's still trying to figure them out, but apparently that was enough pressure to start pushing some others over the edge. We've had Schwab a few months ago, then TDA, and you and I talked about Fidelity probably being a few months from now. At some point, they'd probably get there, but they just declared they're throwing everything up for free as well. I don't know. I mean, what are your initial thoughts on the free trade cost concept?
Well, I think it's to start, it's marketing, right? So like Robinhood, they made money on order flow. That's all they made money on, and a lot of these other custodians make money on order flow as well. So you got to look behind the scenes to see exactly why they're doing it and what the outcome is, right? They're not doing it just because they think that they like their clients. I mean, they're giving up a ton of revenue because they feel that they can make it up somewhere else and take market share.
Well, this is what I find interesting because I've seen a number of people starting to sort of point their finger at Robinhood, but I think we need to take a farther step back. And if you look at some of the history, I mean, ultimately, back in 1975, May 1st, it's called May Day. I mean, that's Charles Schwab, when the SEC said, oh, wait a second here. The cost of doing a trade is no longer going to be standardized. Charles Schwab said, wait a second, I think there's an opportunity, and he cut fees, and virtually all the other major brokerage firms raised their fees at that time. And that's an interesting piece because if you haven't done the research, I mean, you look back like 1935 to 1975 when that rule change happened, the average cost for a lot was basically 0.8 to 1.2%. That's each direction. So every time you trade with no benefit for doing a high volume, right? You're shucking out some dollars there, and that's kind of a scary process. I mean, when you do the math, I mean, oftentimes this is part of the reason I think a lot of people didn't. Frankly, regular clients didn't own stocks back then. I mean, it was just too expensive. Not just the trade cost, but the overall process was just too expensive. So, from the standpoint you talk about, well, not Uncle Chuck isn't just super friendly. He doesn't just love his clients. What do you think some of the reasons are for this zero trade piece?
One of the things you look at behind the scenes is sort of the Amazon example, right? When they came out with Prime, a lot of mom and pop struggled with that, right? To keep up with 1-2 day shipping, very cheap prices, is because they're making money somewhere else, right? It's the loss leader, and trading has become sort of the loss leader for these custodians. So, and I have some notes here on Schwab, which I want to make sure people understand about the cash, right? As of this is according to Jason Swag at Wall Street Journal. As of 6:30, they have $208 billion in cash. That's paying 0.12 to 0.55. Okay, the going rate's 1.75 or something. So essentially, they're paying nothing and lending that money out. So they're making a huge spread on the cash. Their Schwab Intelligent Portfolios, which have $41 billion, forces 6 to 30% cash depending on the risk tolerance of the portfolio. And also, they have their own ETFs in that portfolio as well, which are normally higher cost than they're making. So, they're not necessarily doing this out of the kindness of their heart. It comes down to if they can sort of disrupt and they have the ability to not have that hurt their revenues that much. I think it was 4% of revenues or something like that versus I think TD was upwards of 20 or 30% of revenues. So I think they just took a shot. They said, we're not going to starve if we make this zero, and we'll make it up somewhere else.
Yeah, it's interesting how some of those prices and fees and so forth occur. Most people don't understand that piece. But what I think is interesting, and I'm sure if you were to invest in a Schwab Intelligent portfolio, they've disclosed that cute little conflict of interest in that, right? They make a ton more money if they keep you in more cash. Of course, never mind the fact they're using, in many cases, or most cases, their own funds. So, they're making their money there. But that cash, like you said, it doesn't cost them anything.
And there's nothing wrong. There's nothing inherently wrong with what they're doing. It's just this is why they're doing it, right? It's a loss leader. Trading's a loss leader, and every custodian has to choose sort of where they're going to get their money and what they're going to do. I really applaud Fidelity for coming out and matching it, but also stressing that their money market rates are higher and they don't sell order flow, which is a big deal because most custodians do sell order flow. And so, full disclosure, we use Fidelity and TD, for our clients, just to make sure everyone's aware of that.
Right. Well, and I think it's pretty clear if you've seen our podcasts and such before. Our focus is on the effects of advisory situations like this on advisory third-party money managers like ourselves, on advisors, whether you be a portfolio manager or you're using outsourcing to third parties, and ultimately advisory clients. So, from that standpoint, I mean, we're a money manager. What are the effects for us when we're doing quarterly billing and so forth? What are the effects on a money manager in our decision making?
Well, when it comes down to picking the investments, I think it's just super helpful to have the flexibility. We've always used mutual funds on the NTF list, and we would trade them pretty heavily, not on a daily basis, but we would make strategic changes, on a monthly, quarterly basis. And a lot of times in a fund structure, that's hard. So, going forward, it opens up a lot of avenues for us to not have to worry about transaction costs. So we have a $10,000 minimum, and when you're looking at smaller accounts, the transaction fees matter and they add up. And so this opens up a whole new avenue for us to be able to utilize ETFs. And then also down the line, I know you and I are looking at different stock portfolios out there that we may want to incorporate. Things like that historically would have been too hard for a $10,000, $50,000 account are now available. I mean, you can buy and sell as much as you want. And so these it's just more tools for us to sort of ingest and make our money management process better.
Yeah, I know. I'm kind of interested to see, ultimately, like I said, we use the NTF lists for obvious reasons, but ultimately there are some mutual fund companies that just choose not to pay the custodian and they're not on that list, or some of their funds may not be on that list. So this may open the door to some other solutions that we just didn't have before from a individual standpoint. From your
former role with advisory, there's certain SMA products out there that are fantastic, but they have $250,000 or $500,000 minimums, right? Because they have maybe 200 stocks and they're buying and selling and tax loss harvesting. And these things just you're not able to deliver those on a $10,000 account, where now you have that ability. And I think that just opens it up. From a professional money management point of view, it opens it up to more tools, and that's always helpful.
Yeah, I think now the decision is, does it make sense from a management perspective, rather than does it make sense, and by the way, there are these other costs that we have to take into consideration, and does that outweigh the benefit of a tax loss harvest or something
those other
else?
Costs were always there. It's just becoming more transparent, because if you cut your trading cost to zero, people are going to poke around and say, okay, well, where else are you making the money? So order flow, money market, securities lending, cash, this is how they've made money for 20, 30 years, right? Nothing's changing. It's just that they're, now it's public and it's transparent that the transaction fees are zero, and where else are they making their money?
Are there this is a little bit of a side piece, but when you're working with a custodian, what other factors besides the trade cost were in that process? I mean, is it a total game changer, or was that just a little component for you as a portfolio manager?
Well, we've always, you have a list of things you want to look at in terms of the cost and how they structure, how they handle statements, and there are big 4 or 5 custodians that you focus in on. They've always had commission-free ETF lists, but those ETFs paid the custodian to be on there. So the free ETFs weren't necessarily the best, but they were available NTF, right? And this is a decision we have to make. Like, if you can use transaction fee funds, but not every client's going to be affected the same, and it depends on how much you trade. And so because of the amount we trade, we've always focused on that no commission list. So, with any custodian, you got to see the availability. Are they cutting off certain ETFs? They might come out with something that says, a certain minimum, right? Because for them, you can a dollar trade and $1,000 trade is exactly the same. So there are some inherent costs that they have to control. So we'll see how the future sort of lays out. But in terms of us, it's money market, it's trading cost, and it's all the other ancillary costs that no one wants to talk about. Like, are you selling order flow? Are you, sometimes they charge to mail out statements and what they charge for checks. And so we have a laundry list of things. This is just one component.
Well, I think there is one other bigger, I think, topic touch that I want to hit on here, and that is, there's an awful lot of clients with all of these custodians, with Schwab, with TDA, with Fidelity, some more than others, where clients are trading themselves. And do you think that's going to be good or bad in the long run for clients when you've eliminated effectively the only thing other than taxes for a non-qualified account? You've eliminated the only inherent pushback or pain point on making a trade. You think they're going to trade like bunnies now?
Well, I think, so the Dalbar study has its holes, has its flaws, but inherently I think it's a good study that clients end up less off in terms of return because of the fact that they're trading and the mistiming of trades. And I think this will definitely have a negative effect on those people because there are no restrictions left for them to just trade as many times as possible. When I was talking to someone the other day, they were still sort of shocked, a fellow money manager. So literally I can trade 50, 60, 70 times a day and there's zero sort of inherent cost. Obviously bid ask if you're, that's an issue if you're trading thinly traded ETFs, but that's another topic. So yeah, I think it's going to have some effects on certain people, but to be fair, would those people have traded any more or less if $5 got in their way? I mean, that's the hard part to say. Like, if you're already sitting behind your computer and it's not your job and you're firing off ETF trades, I think this makes you happier, but I'm not sure you're going to trade any more or less.
Yeah, happier until you see the results, right?
Well, if anything,
exactly. The proof's in the pudding.
If anything, when it went from $60 to $70 down to $5, you could make the argument, right? That's a bigger switch. An interesting key here is what, maybe going off the rails here, but what are the wirehouses and broker-dealer platforms going to do? Because they're still probably charging.
Right.
Some of the wirehouses are probably still in the $50, $60, $70 range where, if you're phoning in the trade and there's a person on the other side, there's a cost associated with that. I wonder how they're going to follow because, if you're trading on that sort of platform, and you're looking over at Schwab and Fidelity saying, well, I can do this for nothing over there.
It's always funny, right? It's, again, it goes back to nothing in life is free. It just means it's hidden somewhere else. And so now I think I've always said knowledge is power. And ultimately this is what you end up with. We're trying to talk about some of these things. Are there other issues that you have in regards to the zero trade costs?
Not in terms of clients, not necessarily. I think it what also might come to light is the unique ETFs, the weird ones that can cause a lot of issues, whether they're leveraged, inverse, or thinly traded. I think people, assume that they can always bolt out of trades at the price they want, and with the free trades, I think that could be a risk. But to the overall market, it's very minuscule. It's just it could be isolated to a couple folks.
Yeah, I think it'll probably take 2-3 quarters, maybe a year, and suddenly the revenue expectations and what have you will sort of level out, and everyone will get comfortable with what revenue these firms are giving up versus what they're going to end up making as more pressure is put on their other revenue avenues, if you will, and it won't be any big deal even to these companies. I think it's in the long run, it's probably a good thing in my opinion. Is that your final assessment as well?
Yeah, I think so. I think it's good for clients. I think that we have to keep in mind what the custodians are going to do next because, they keep having these revenue centers go away. They're going to have something, right? I mean, it could be an asset-based fee for advisors. It could be an asset-based fee for clients. We don't know. Well,
and I think I think Schwab just laid off a bunch of people too. So I mean, fairly recently. I mean, it's these are sometimes the ramifications. It may not be that they're going to lose a ton of revenue in the long run, but if it changes their center and changes their needs, then sometimes that means people are actually affected, and that's the employees.
That's a good point. It just comes back to your value add. If you want to buy a bike or a pair of shoes, you go to a small business and talk to the person and walk them through it. You may pay a little bit more, but if you go to Amazon, you're ordering off a picture, and what you get is what you get. And there's value in both, right? There's value in not getting in your car and driving to talk to someone, and there's value in having someone help you. So it just depends on where you value your money being spent.
Right. All right. So you got this? Got anything else you want to throw at this topic?
No, I think the future would be interesting to see what custodians do, to see what wirehouses and broker-dealers do for those advisors that are still at a captive wirehouse or even a captive independent BD. I know that's sort of ironic to say, but how they handle that, because they don't have the margins that a large custodian does. So I think for advisors, that's going to be key to see what unfolds there. And for us, what else we have to be on the lookout for in terms of custodians and where we place our clients.
No, absolutely. All right. So on that note, I'm going to move on to recommendations. From the standpoint, my recommendation, and I did finish this. It's a 3-part, basically decoding the brain of Bill Gates. It's a Netflix documentary. I was never a big Windows fan, not necessarily a big Bill Gates fan. But I know you're the Windows poster child. But from my perspective, I found it incredibly intriguing to see how effectively his brain works. It was pretty eye-opening. It's just different.
And I'm a little envious and jealous. I mean,
me too.
It's so impressive to be around people like that who just have the ability to. Their brains are just on a different level.
Well, so it somewhat saddens me because a documentary is supposed to be where you watch, listen, and learn about someone else or something else, and when you're looking at someone else, what it does is shine a mirror on yourself and says you're an idiot.
I think it was.
I don't read 10 books a week.
Yeah.
I don't.
It's okay. You're like the rest of
the
us.
World with new toilets.
Yeah, it's all. I mean, some of that's bullshit when people are like, "Oh yeah, I read this last week." I mean, most people read when they can, but they're not. No one's Bill Gates. I mean, the guy was like traveling with 20 books at a time. It was amazing.
Yeah. But anyway, so he's an expert in many things, and frankly, and this is what I do like though, because he was under so much pressure for so many years for just being greedy, and the reality is he is retired and yet spending more than full time, giving back, and not just giving back like, okay, here's a check, here's a check, here's a check. It's instead he's diving into the problems, and it is his time, which is hugely valuable. And then, of course, garnering billions of dollars to throw.
And I second that. It was a great documentary, definitely worth it. I think it's 3 episodes, and definitely worth it. So,
yeah, they're like an hour apiece. So.
Cool.
All right. So, what do you got for a recommendation?
Well, we're on episode 14 now of this podcast. So, when I go to conferences and talk to different people, they're always asking me about the setup. How are you pulling it off? What are the tools you use? And to each their own. We've had our issues with tools and software, but so my recommendation is Pippa, which is the podcast hosting software we use, and it's pretty amazing the how clean the UI is, how easy it is to use. For $25 a month, you can upload all the podcasts you want, and they give you a special web page tracking analytics and embed codes, so you can embed it in emails on your website, etc. So, the more questions we get, we probably have to maybe do a quick podcast or some content around a podcast about a podcast,
podcasting.
like the Seinfeld podcast. So, we can talk about some of the tools and things we're using and what we're struggling with too. So, that's what I got for this week.
All right, good deal. Well, on that note, let's wrap this up. So definitely like, subscribe. Speaking of subscribers, we're on episode 14. Have we made it to 14 yet?
Likes on YouTube, we're I think subscribers. We're at 9. I think last time I checked. So yeah.
All right, help. We're 2 brothers from another mother. We need some help. Let's get some more subscribers. We got to have more subscribers than episodes. So anyway, like, subscribe. If you need to make a comment, just go to our Connect Us page on PotomacFund.com, and we look forward to seeing you next time.
Later.